This is monthly data. So that spike actually goes much further down to the bottom of the chart than what you're seeing here. This is monthly data, not daily. And then on top of that, back in 1980, when we had that spike, there was a lot of above ground silver. There were enormous government stockpiles still. The economy wasn't in trouble. Like I said, debt to GDP and all of those fundamentals. And we didn't have the entire world is about to rush into the precious metals to protect. Like in China, it's already happening. The West, for some reason, has been totally asleep. And it's really too bad that people weren't jumping on gold a couple of months ago before the last big rise. It's really too bad that people weren't jumping on silver back when it was $20 instead of 47 bucks. This is basically house price inverted because it's in gold. So gold's maximum purchasing power, and the home is super cheap when it goes down to the bottom. And we looked at this a little bit and discussed it before the video here. And you looked very closely at this, and it looks like there's about 12 data points per year. And so this is a monthly chart, putting the peak of gold at around $600 or $650, not $850. So that spike at the bottom at 1980, where homes become super cheap measured in gold, actually goes much lower than what it's showing, probably down to 50 or below, 8, 9, 10, where a brand new bull market is just forming instead of one that is hyper overvalued and overextended and about to crash. This time, I believe that we're going to blow way past that 1980 spike down on the bottom. So when you're looking at the value of your gold compared to real estate, you sort of, in your mind, have to flip this chart upside down. Those are the gains in value that your gold is making against real estate. This is how cheap a house is becoming if you're owning gold. So, yeah.
Exactly.
Any dollars up to $3,800.
Yeah.
And so it doesn't have that data in it. And that means that that yellow line just fell below the, we're probably at like less than about half an ounce of gold now, something like that for a mortgage payment. And so, it just shows you that, throughout the centuries, period, throughout human history, gold protects your purchasing power. And right now we're in one of these cycles where the safe haven asset becomes the asset class with the maximum potential gains in purchasing power. Recently of how many days silver spent above $40. And that this is monthly data. So that spike actually goes much further down to the bottom of the chart than what you're seeing here. This is monthly data, not daily. And then on top of that, back in 1980, when we had that spike, there was a lot of above ground silver. There were enormous government stockpiles still. The economy wasn't in trouble. Like I said, debt to GDP and all of those fundamentals. And we didn't have the entire world is about to rush into the precious metals to protect. Like in China, it's already happening. The West, for some reason, has been totally asleep. And it's really too bad that people weren't jumping on gold a couple of months ago before the last big rise. It's really too bad that people weren't jumping on silver back when it was $20 instead of 47 bucks over again. And you're going to see this very rapidly, especially if it's coincident with, in 1980, real estate wasn't in a hyper bubble. And it is today. It's in a gigantic bubble. And if silver is going north at the same time that real estate is crashing, we could see a day come where less than half the amount of silver is required to buy a single family median price home versus this chart in 1980. So, this chart says that you probably have 5 times gains. In other words, you could sell a house today, invest in silver, And if you are able to nail the peak, you'd be able to buy 5 homes with the proceeds from your silver. Well, it's probably going to be more like 10. That's my point, because the fundamentals are there this time. So anyway, okay, let's...
Yes, so that could even be 1,000 ounces of silver, right? A 10x move from here is 1,000 ounces of silver. That's 2 monster boxes. A lot of people have 2 monster boxes, so...
Yeah, right.
That's
right.
doable. That's doable.
It is doable.
Yeah. So what I have here...
And, it's just math, and then you take what happened before. So it's a repeat of history, adjusted for inflation, and then you add the difference in the underlying fundamentals. Real estate was not in a bubble. The stock markets were way undervalued, and silver are going north. You're going to see some amazing priced in gold, priced in silver, fire sale prices on everything. Stocks, bonds, which you probably don't want to touch, and real estate, which you probably want to consume as much as possible. Get fat on real estate.
I can't wait. Our next chart here, renting is now significantly more affordable than buying a home by one of the widest gaps ever recorded. So we can see here,
wow.
Yeah, the dark blue line, the rent to income ratio, and the light blue line is the mortgage payment to income ratio. So you can see that owning a home got significantly more expensive, like twice as expensive, or I'm sorry, it's not a true zero, so it's not twice, but significantly more expensive than renting, and it's happening again now. So that was the same as the global financial crisis. And are we having another crisis?
Now we're way up past the peak of the global, we're way up past the peak right now of the global financial. Well, that wasn't the global financial crisis. That was the peak of the real estate bubble. That's above, it's like 32, I guess, on this chart, or 30, yeah. But we're above that. We're up at like 32. We're up above it just slightly. But the thing is, to be up above the 2006, 2007 real estate bubble that led to the global financial crisis when we weren't in a stock market bubble, this is something amazing and scary at the same time.
Exactly. And if it comes down, what is going to cause it to come down? Like something has to give, right? Something has to crash. Things have to move fairly rapidly to bring back into balance.
Sort of bad news for the economy. Go ahead.
Exactly. Let's see how bad they admit that it is, and maybe it's even worse. So according to them, it would take one of 3 things or a combination of them for affordability, housing affordability, to return to the 2016 to 2019 levels. Okay, here are the 3 things. Either the median price of a single family home would need to fall 38%. 38%
Whoa.
To about $250,000. Okay, that would have to happen to make houses affordable. Or median household income would have to rise more than 60% to $134,000. I don't see that happening. Or the third thing, the mortgage rate would need to fall to 2.35% from roughly 6.5% where it is today.
Okay, looking at this, this is just an opinion. So take what you will from it. But I feel like the only one that could possibly happen and will most likely happen is that all of the real estate will fall. We are in for a crash because that is what is in a hyper bubble. Right now, incomes are depressed. But if you go into a crisis, and there is one brewing right around the corner, incomes do not rise in a crisis. Unemployment rises. And so I have a feeling it's probably going to be bigger than that 38%. We're going to see something similar to the global financial crisis, but even worse because it isn't just real estate. It's real estate, stocks, and bonds. Okay.
Yeah.
What's your take?
Yeah, no, I agree with you completely. I don't see mortgage rates dropping. Not to that extent anytime soon. I mean, we're just in a 40-year, declining interest rate environment. We're probably entering a 40-year rising interest rate environment.